landlords are finding it untenable to stay in the letting market if they have a mortgage. Very basic thing there. It's not the rise in interest rates, albeit that that's unhelpful because they've now had a tripling of their interest rates. It's the fact that George Osborne brought in 4 or 5 years ago, albeit on a graduated basis, that landlord can no longer offset the interest against the income before tax, as you would be able to in any other format of business. That has completely distorted the ability of a private landlord to stay in the market, because effectively what they're doing is they've got their rental income coming on one side, they've got their costs on the other. It used to be they could offset the interest, they can't any longer, so they have to pay their taxes. Normally in central London, you can't feel too sorry for them, at 40 or 45% first, and then and only then can the interest be paid. And I've got a number of landlords who are deeply underwater on an income versus costs basis, and so they're being driven to offload their properties. And you think, oh goody, that means that they're going to be private people can buy those, but the reality is, of course, it deprives the people who want to rent of that rental stock, and that drives the rental prices higher, and is causing a great shortage for tenants, driving prices higher, making the whole thing untenable.
Most of my work is in Belgravia, and that is quite a challenging market at the moment. There's a lot of property for sale and there aren't a lot of buyers. And I know that that's slightly different than other locations, let's say like Notting Hill, where there is a shortage of supply of houses and a ready supply of buyers. So it does kind of depend where you tend to specialise. I think areas come and go. You know, in the 90s, nobody wanted to live in Belgravia. Then in the early 2000s, it became very popular with bankers, American, European bankers, hedge fund guys and people like that. And now they prefer to be in more West London, more up in as I said earlier, in Notting Hill. So, you know, places come and go in terms of fashion. But I think it's got to the point where actually Belgravia is very, very good value now. There's a lot of stock, there's a lot of choice, and if you've got, you know, you can probably negotiate pretty hard and cut yourself a good deal if you're a buyer.
I think a lot of foreign investors have been slightly put off, potentially waiting on the sidelines for opportunities to show themselves before they deploy their investment strategies. I think the next thing we need to see is really that the mortgage products change, and the mortgage products start to become more longer-term facilities with smaller deposits, and that will help people to actually plan and get onto the ladder, rather than having to have massive deposits and relying a lot on parents and savings. So hopefully what we're going to see in the coming years is a more normal market, less inflated, and one that actually enables people to get back onto buying versus renting, which has been a lifestyle choice for many in the past kind of 10, 15 years, I think.
It's been a challenging market. Obviously the cost of borrowing is a big concern, and that's not only a UK problem, it's a global problem. And we were obviously concerned that that may slow the market down, but actually super prime and prime has been surprisingly resilient. I think people probably see it as an opportunity as prices soften a little bit, because you know that at some point prices will return in prime and super prime markets. So actually we're quite encouraged by the activity at the moment.
We're seeing a lot of polarity in pricing. I think we're seeing a lot of people, we're seeing a general contraction of the number of properties available to buy, which is usually the case when owners sense uncertainty. And that's imposing its own pressure on the market. I think we're seeing some pretty unusual prices being achieved across the board. We're seeing some attractive pricing, people getting below the market in order to attract interest, but we're also seeing some extremely high prices being achieved for best-in-class property that's in brand new condition. So there's a flight to quality on. I think some agents are getting it wrong. I don't know why, because you don't make any money advertising a property. You got to sell it. But you know, I've seen prices vary by as much as 25% in terms of asking price?
I think it's changed. It's changed only in the last 3 weeks. We've seen obviously the negative press and the rate rises change the market. We're still having best offers on best in class and things that do not have any negatives. For example, if it's a 5-bedroom house and it's centrally located with a good garden, we've still got lots of buyers for it. We launched a house only today. We've got 9 viewings on it today. So I've been running around showing that house today and we've already got a positive response on that house. But the things that were a bit more periphery and maybe missing something, maybe not as big garden as it should have, or off-street parking where in an area where you normally expect it, those are the things that are being held back, I think. And I think if in a market where things were very fluid, you'd have offers on it. But right now, it's taking longer to get there.
Obviously, coming out of COVID, we've had a few very good years. I think a lot of people were very worried in 2020, and actually it's the strength of the market has been proved by the robust volume of sales that we've seen. I think every agent in central London has been very busy, and outside of central London, and particularly in the countryside as well. Our firm, we've seen the last 2 years in terms of transaction volumes has been a record number of transactions. Values have softened a bit, looking across the board, but there's been a huge amount going on as people have sought to rethink the way that they live, whether that's domestically or internationally. And looking forward, obviously, we're seeing the winds of change creeping into the market. As at the beginning of last year, really, we started to see inflation kicking in. Obviously, the war in Ukraine has caused some eyebrows to be raised. And so looking forward, we have an election next year. That's starting to be the topic of more and more conversation. So we're seeing the market cool a bit. Transaction volumes have dropped, but ultimately it's London. People always want to be here. Just from our point of view, our firm, we have the biggest pipeline of properties under offer that we've ever had. A degree of that is because sales are taking longer to go through. People aren't taking a view on any sticking points as much as they used to. So there's a bit of a backlog in terms of the transactions that are under offer, but the amount of sales that we've agreed, I think, is testament to the fact that there is a robust market.
What's the market like in North West London? Well, as Mark Twain was so famously quoted, they ain't building any more land. And consequently, there is a shortage of stock. You would have thought, given the energy crisis, the credit crunch, cost of living crisis, that more properties would appear on the marketplace. And I'm talking about the range between about 1.5 million to say 10 million. There isn't a lot of stock around, but actually there are not a lot of buyers. So the market is much more considered, it's calmer. The cost of finance is hurting for those that need finance. The cost of financing buy-to-let property is hitting the market hard. So a lot of landlords, rather than paying in to their companies or paying in to keep their properties, they're actually selling their properties. So the availability of apartments to rent from about 1,000 to 1,500, from 500 to 1,500 pounds a week is shrinking, and therefore rents are going up.